Michael, you're telling me you can put away money pre-tax and have it grow tax-free?
Yes. Welcome to Couple Bull. My name is Michael Dunham, and with me today is Patrick Fontana, the founder of Fontana Financial Planning.
Cheers, Michael.
Welcome. So, Patrick, to answer your question, yes. And the way that we can do that is by using what's called a HSA or health savings account. So, to get started, why don't we break down what somebody has to do in order to be able to save into an HSA? So, what's the requirement before you're eligible to open and invest in an HSA?
So first off, you have to have a high deductible health insurance plan, which generally has the HD, in front of it. And there's lots of choices on what the deductible is. But if your high deductible plan is available, then you can open and fund an HSA. One of the things I'd recommend when you're looking at what kind of health insurance you set up is how much is my health insurance, and high deductible generally costs less. If you're healthy and don't need to go to the doctor a ton, then that's a good choice, saving money right up the front. And then it opens the door to put away the HSA money.
Yep. And so for this year here in 2025, if you're on an individual health plan, you can save $4,300 into an HSA. If you're on a family plan, you can save $8,550, so almost double. And then if you are over the age of 55, you get an additional $1,000 catch up. So that's one thing to note. It's a little bit different than most of the other catch up contributions, which are age 50. So 55 is the magic number for an HSA. The cool thing about those contributions is you can put them in pre-tax. So you get a tax deduction for the money that you put in to the HSA. You have the ability to take the money out down the road for any qualifying medical expense, and it comes out tax-free. And in the meantime, you can choose to invest that money and it grows tax deferred as well. So it's the only account type that's triple tax exempt. The other thing that I'll bring up that is often overlooked is it's becoming more and more common in today's day and age for employers to offer an HSA match as a benefit. So sometimes they make you jump through a hoop, like maybe you have to go get a physical or go see the doctor, maybe take a certain number of steps, or there may be various hoops that you have to jump through. But once you jump through those hoops, maybe you get $500, $1,000, some nominal amount gets automatically added to your HSA for you.
And some incredibly generous employers even fully fund the HSA. So I know as a firm, that's one of the things we've been doing from early on when we figured out that we could get a tax break as a firm to put away money tax-free for our employees. I know I've been maxing out my HSA for a while, and you've been maxing it out at least since we started the firm. Once you do save that money and get the tax break and it's in the HSA account, what's the important thing to do with it?
Yeah, to invest it. And I'll say this is the biggest mistake that we see people make. And a lot of times this comes to light when we're reviewing somebody's tax return. On a tax return, we can see contributions made into an HSA. We can also see distributions from an HSA. And a lot of people just naturally don't associate HSA account with investing. And so a lot of times it'll come up as we review the tax return. We'll see somebody's putting money into an HSA, but then they're just turning around and taking it all out, or they're just letting it accumulate in cash within the HSA. And so the thing to know, if that is you watching this and you're doing one of those two things, it's totally fine. But there may be some opportunity cost in the fact that instead of doing that, you can actually invest the money that you put into the HSA. And a lot of times, if you're contributing through payroll with your employer, which is how most people who are not business owners add money to their HSA, it works very similar to your 401k. So a lot of times the employer chooses where that HSA account is held, and then there will be some sort of investment lineup where you can go in and you can see, the S&P 500 fund or the Russell 2000 fund or whatever investment options that HSA makes available. And then you can go in there and you can allocate, I want X percentage to go to this fund, and this fund. And then every time you get paid, when that money moves into the HSA, instead of accumulating in cash, it automatically gets invested just like your 401k does.
So I know my HSA, once I figured out how this works and that I could invest it, the growth of the money is gone well beyond what I've put in. And as that continues to compound and I continue to add to it each year, that balance, should it grow big enough to support healthcare costs, that's our idea of endowing your own healthcare. If you build up enough money in an HSA, you can be drawing money out to pay healthcare expenses and pay no taxes on it. There's a little known rule that Michael informed me about that's also just kind of a keep it in your back pocket gotcha. If you ever needed to get money out of the HSA, can you repay yourself for healthcare expenses?
Absolutely. And so this is, I'd say, like a get out of jail free card for people who are worried about the idea of investing money. What if I need it one day, right? And so the rules state that you can reimburse yourself for qualified medical expenses at any point in time. And so if you're that type of person where you'd like to have the flexibility of being able to access the HSA money down the road, you can keep all of your receipts every time you go to the doctor, every time you pay for a prescription, anything that qualifies. You can keep all of those receipts or put them into an Excel spreadsheet or do whatever you'd like to do to track it. But let's say over the next 10 years, you incur $50,000 of healthcare expenses in one form or fashion. 10 years from now, you could take $50,000 out of your HSA to reimburse yourself for all of those expenses, and it's done tax-free, even though you didn't necessarily have a $50,000 healthcare expense in that one single year. And so when it comes to the idea of endowing healthcare in retirement, one, you have this get out of jail free card option. And then two, a lot of the medical expenses that you incur throughout the course of retirement, you can also use the HSA funds for. And so that's where the idea of, let's say you accumulated $200,000, $300,000 of money in this HSA, which there's a lot of studies that show that what's the expected cost of healthcare in retirement, it's typically a pretty significant amount of money. And you can use the HSA to pay for many of these healthcare expenses as you incur them in retirement, if you choose to forgo kind of taking the money now to pay for any healthcare expenses that you incur along the way.
Excellent discussion, Michael. I'm proud that you are investing your HSA, maxing out your HSA. And although younger than me and take a little bit to catch up, we're both on track to be endowing our own healthcare. And it's a great goal to move towards.
Patrick, how do you want to wrap us up today?
I'd say we turn the lights out. Rebalance with discipline. Well, I guess our